The countdown is on in Europe. This is Bloomberg Markets European Close with Guy Johnson and Alex Steele.
Friday the 8th, 30 minutes to the close. What do you need to know out of Europe this hour? Well, European stocks just drifting, really. This as US job growth disappoints for a second month in a row. The euro tracking a little bit higher, still around kind of or below 116, though, against the dollar. Ireland abandoning its 12.5% corporate tax rate, removing a major hurdle to an OECD deal, try to say that fast, that could deliver a minimum tax rate of 15% for global multinationals. We'll talk about that in a moment. And the EU is set to explore joint gas purchases and storage as weather forecasters warn that temperatures and wind speeds are set to drop in the near future. Interestingly enough, Gazprom says that exports continue to China despite a major fire at the Amur processing plant in eastern Siberia. Let's take a look at where the markets are right now. Equity markets, as I say, just sort of drifting right now. We're down a touch. We're down by around 0.2%. Incredibly choppy week. We're continuing to see gas prices coming off, but we still remain, Alex, at very elevated levels.
Yeah, OECD deal. It's easy. Just say it real fast.
OECD, yeah.
You work on that. Okay. So within the markets, it looks like we're buying energy and we're buying value. That kind of is what we're looking at here. So energy still up almost 3%. You have WTI at 80, which is the highest level since 2014. Financials also getting a nice boost as well. But after that, it's the S&P Tech, which is leading the way, which is the third best performer in the S&P. Now, NASDAQ 100, though, trading a little heavy. And I should point out, volume not great across the board for all the major indices. Okay. NASDAQ 100 off by 0.25%. But this is what I did want to really focus on here, and this could be a reason why you're also seeing a nice bid into financials, is the 210 curve here steepening in 128. You have the front end really anchored by the Fed. If we're going to make that distinction between a taper and any kind of hike on that jobs number, the back end, though, for yields being led higher. Is it really that here in the U.S., or are we at 1.6 because of what's happening in the U.K., because of higher inflationary issues in the U.K., potential growth issues in the U.K., and that's just dragging up that long end?
Alex continues to blame us for pretty much everything at the moment. I'm just putting it out there. It's not all our fault.
Yes, it is.
I appreciate that
everything is your fault.
Maybe the gilt market has been having a disproportionate effect, but nevertheless, not all our fault, I promise. The US jobs report may be a contributing factor to all of this. Basically, the September number, the slowest this year. There's all kinds of weird things happening in the labor market in the United States. People are not coming back into the labor market that many people thought would. Marty Walsh is the U.S. Secretary of Labor. He spoke to John Ferrer a little bit earlier on this very issue.
It's about the pandemic, and this is not just an American issue. This is a worldwide issue with participation rate in the workforce. We clearly have more work to do. People are concerned about the Delta variant. People are concerned about their health, and I think, quite honestly, a lot of people are reevaluating their work-life balance and changing careers.
The Labor Secretary. Let's recap what we know, what we don't know, what we need to know with Bloomberg's international economics and policy correspondent, Mike McKee. Mike, we talked about it since the number came out. Where is everybody? Where are the workers that we need to fill all the job openings we know exist?
Well, maybe we need to ask an astronomer, because what we've got is kind of a black hole into which those people have disappeared. This is the total number of people who are employed. And as you can see, we not only have stalled out in closing the gap, but this is the rate at which we would have added more people into the employment roles had the pandemic not happened. So we still have a pretty big gap to fill. It didn't change all that much with this report of 6 to 8 million people, depending on how you're counting it, and they're not there to hire. We've got the jobs open, but we don't have the people there. Let's take a look at some good news, though, in this report. It wasn't all bad. One thing that we did see was a rise in hours worked, a significant rise of 0.2 in hours worked. That tells you that at least the overall economy is not rolling over, because those who were at work were working harder. Interestingly, though, hours worked did not go up for people in the leisure and hospitality industry, even though there were only 76,000 jobs created there. A little bit odd that maybe because people were staying home and not going out, the two factors could be related. And finally, let me just defend my colleagues in the business of forecasting. This is the difference between what we get in terms of jobs and the forecast. And as you can see, it was very close for a long time. Of course, nobody could account for the pandemic. But look what's happened since. A lot of volatility. There's no models that account for what happens when you reopen the economy. And so it's very hard to forecast why you got 0 to 770,000 as the range today for forecasts. Closer to 0 than 770,000. But it isn't easy, guys.
No, it's not. Okay, fine. It's not easy. All right, Mike McKee, thanks a lot. Really appreciate that. So other stories that we're following today from Europe. You got global talks to reshape the corporate tax landscape are resuming today. You got Ireland, Estonia, and Hungary announcing that they would sign up to the deal, providing a boost to the talks. Irish Finance Minister Pascal Donohoe and the U.S. Treasury Secretary talked about the agreement earlier today.
The agreement as drafted, which I believe will be maintained in the OECD and beyond, is now for 15% as opposed to at least 15%. I was making the case for that kind of clarity, that kind of certainty. It's now there, and it's one of the key reasons why Ireland has decided to join the agreement, and I hope this agreement is successful.
This agreement will be finalized in the coming weeks, and foreign headquartered multinational corporations will face a minimum tax in all places they do business, just like U.S. headquartered multinational corporations.
Joining us now with the latest is Caroline Connan, Bloomberg's EU reporter. Caroline, what actually happens? Like, what are we looking at in terms of the actual rules, and what's the implementation timeline?
So we're going to have a statement from the OECD about this agreement in about 1 hour from now. But clearly the fact that Ireland joined this deal removes a major hurdle in the implementation of this global minimum tax of 15%, because Ireland's historical corporate tax rate at 12.5% was kind of blocking the EU in moving forward. But some hurdles remain because some countries, for example, Poland, are seeking to exempt some activities and could perhaps ask to have this implementation partly on tangible assets and partly on payroll. Then you've got some countries like China who are concerned that companies with big revenues globally but very small subsidiaries could actually be hit harder, especially Chinese multinationals such as Tencent or China Life Insurance. You also have the hurdle of how to share profit from the digital taxation. And in fact, India could ask for this global tax deal to be slightly delayed because they want to share a bigger profit from digital taxation. And finally, of course, you have implementation. This will require changes of treaties, and the US Senate has already threatened to block ratification. So still a few hurdles, of course, towards this global tax deal. And if it all goes according to plan, implementation should start in 2023 with a transition period of about 10 years.
Everybody's saying if it's not now, it's never. Maybe we're getting there. Caroline Connan, thank you very much indeed on the OECD deal. Let's talk about what's happening with Elon Musk's travel plans. The Tesla CEO, yesterday in Austin, Texas, which is going to be the new headquarters. Today, Berlin. Tesla hosting thousands of locals this weekend at its German factory. That factory has been delayed by several months due to legal challenges. When are we going to see completion? Because this is a huge part of the plan for Tesla in terms of its rollout in Europe. Joining us with the latest, Aggie Cantrill from Berlin. Aggie, what do we know? What's he coming for? What's he going to say?
So I think what's interesting, Guy, is that he's inviting 9,000 locals from the Berlin-Brandenburg area to this factory just outside Berlin. And what's interesting there is that this factory has come up against a lot of pressure from environmentalist groups and local organizations, people who are criticizing the environmental impact of the factory, but also its impact on things like the groundwater for the surrounding agricultural area. And so I think a lot of this will actually be an effort to try and get these people on side, because the project is actually still awaiting a lot of those approvals, as you say. And it's also worth noting that this factory that's part of a much bigger project from Tesla is also worth noting as part of a requirement for German automakers to also be responding to the changes and the needs for electric vehicles in the future. And Daimler, Volkswagen, BMW have all made big commitments to transform their own output to make more EVs in the next 10 years. And it's going to be important to see how they can respond to the likes of Tesla in their own country.
Yeah, it's also going to be interesting to see whether we've got enough electricity to actually power all these cars. Aggie, thank you very much indeed. Aggie Cantrill joining us from Berlin, awaiting the arrival of Elon Musk. Talking of that, Europe apparently is going to see cooler weather next week. Apparently wind speeds are going to drop. But as the weather gets cooler, heating demand is going to pick up. That's going to add pressure to already strained energy markets where price moves have become, I think this is an understatement, extremely volatile. Here with the latest, Rachel Morrison, Bloomberg Energy reporter. We've seen incredibly volatile markets this week. I can't remember if it was Wednesday or Thursday when gas surged to the moon. What happens next? The meteorologists are telling us it's going to be colder but less windy. That doesn't sound like a great combination.
Yes, that's right. Today, prices have come off a little bit. There's a little bit more calm after an extremely dramatic week. But we do expect the weather to get colder. Winter is starting. And at the same time, wind speeds are going to drop. So that means less supply and more demand, which means higher prices. So although things have calmed down at the end of this week, next week there could be more. And we have one analyst firm saying today that if it's a cold winter, European gas stocks could drop to zero, which would be quite dramatic.
Just one quick follow here. Do we have an idea about what happened in China? They say that they can still get gas to China and it's not an issue, but Siberia, one of their plants is sort of on fire. Do we have an idea of sort of what the implication? I mean, things like that are going to definitely have some kind of psychological effect on this.
Yes, these kind of fires and accidents happen from time to time. We understand that this fire was actually on part of a line that wasn't being used, which is why supplies continue. But we are in such a precarious position now that events like this become more serious. They become more difficult to deal with. And as you say, it all feeds in to how the market views the supply situation, and the market's nervous at the moment. So any kind of fire, videos on Twitter, that can really set things off.
Yeah, the pictures on Twitter were quite incredible. As you say, maybe this isn't going to affect in the near term, but it's another piece of infrastructure that is going to be under pressure. Rachel, thank you very much indeed. It was a fire on the Russian side feeding into China. But Alex, the problem therefore is that maybe China, if it doesn't get the gas that it needs, maybe buys more on the open market, which is a competition story with Europe again, and therefore makes and exacerbates the situation even more.
Or goes to coal, which then is going to drive up coal prices when everyone's trying to compete for coal now too. So the trickle effect could be more significant.
Yeah, it's not good news, let's put it that way. Coming up, we need to kind of feed this into the stagflation narrative that we've been talking about this week. The growth narrative, is that strong enough? Are we going to continue to see inflation outpacing it? Are we heading for stagflation? If so, what do you do with your portfolio? We're going to be joined by Mizuho International Head of Multi-Asset Strategy, Peter Chatwell. That conversation is coming up. This is Bloomberg.
Thanks to this exceptional response, we are now witnessing a highly atypical recovery. We still need to manage the exit from the pandemic very carefully, because this unusual speed of the recovery is also creating frictions that could refrain growth.
Inflation, one of the factors maybe within that mix. Christine Lagarde, the ECB president, saying the European economy and its recovery thus far highly atypical. I think if you look at the payroll data out of the United States, everybody's scratching their heads. The economists really are struggling to get a grip on what is happening on both sides of the Atlantic. The Europeans, in many ways, not suffering the same labour market story that we're seeing over in the United States and here in the UK. Peter Chatwell, Mizuho International Head of Multi-Asset Strategy, joining us now with more. So what do I do with all this? At the moment, we have a huge amount of demand for labor, but a lack of supply. People are not coming back into the labor market. The Fed's trying to figure out how to sort of taper its policy, trying to finesse that policy. It wants to keep the labor market strong, but we've got this mismatch at the moment. The ECB's got a different challenge to deal with. The Bank of England is kind of having to deal with all of this at the same time. Yeah. If you look at what is happening in the rates market at the moment, Alex keeps blaming the UK for what is going on in terms of rates going higher. But is what is happening in the UK ultimately going to be the story elsewhere?
The UK is something of an outlier, I think, because what's happening is the market was egregiously mispriced. The market was thinking that the UK rates were going to be like European rates. Yep. No, UK rates are going to be like US rates and probably above, because the UK economy really hasn't rebalanced, so doesn't really have produce much goods for external consumption. So because it has that twin deficit problem, the currency is going to be weak, and that means that it's very vulnerable to these imported inflation costs. So that, with the tight labour market, means that the Bank of England has a lot of potential to put rates up, much higher than the market is currently pricing. We think they can get bank rate up to 1.5% by the end of the cycle, so it's 2025. And that's still nowhere near being priced into the curve.
And Peter, if that happens for the BOE, where is the Fed on that? Because I'm interested to see how much this differential we can get.
Yeah, that's a great question. The Fed has a completely different set of scenarios to it. You could say that the Fed also, or the US economy also has the twin deficits, but it has the reserve currency. And that means that the Fed reaction function will be completely different to that of the Bank of England and also some of the other central banks that you've seen moving rates up, the RBNZ, Norges Bank, and of course many of the emerging economies have been putting rates up for a long time. The Fed, on the other hand, has the systemically important currency, has an economy which is quite used to having very low interest rates. But I think the main problem that the Fed would have if they tried to put rates up faster than is currently priced, indeed, if they tried to follow the rate path that they have that is priced in for 2024 as well, it would be horrendous because the dollar would be so strong that it would cause, for the globe, it would cause a major slowdown, and that would mean that the Fed can't actually deliver on that path.
Okay, so what happens next? We've got a really confusing labour market. We've got inflation picking up. We don't know whether or not that's going to be temporary, transitory, call it what you will at this point. What do you do with rates? What do you do? Like, where do we see the story going? Because if inflation is going to stay as high as it is at the moment, then rates have to at some point start moving up. Or do we end up with a kind of more permanent gap between the two, i.e. we're basically going to live with negative real rates for an incredibly long time?
Yeah, the real rates is still something that we're going to have to deal with, have to get used to for a long time. So, and that's, I think, the ideal outcome here, which is that debts will be inflated away to a large degree.
So you don't want to own bonds?
Largely, you only want to hold bonds if you have to. It would be much better to rather than be holding rates products, it'd be better to be holding credit products, because at least they're giving you some upside in this inflationary environment. It is going to feed through into higher revenues for corporates, for example. It is going to create more volatile markets, and actually it's going to create a stronger real economy, which is good for financials. So what I think, there's two dynamics that I would like to capture. I'd like to capture inflation protection, which you can do through curve steepeners if you can only trade in rates. But I would also like to capture credit spread. And I know that there are a lot of concerns that credit spreads are very tight. And at this point in the cycle, getting towards tighter monetary policy, that could be an undesirable investment choice. But I don't think that, with the exception of the Bank of England, I don't think liftoff is anywhere near for most of the central banks. And for the ECB, I don't think they'll lift off this cycle.
So, Peter, from the way you're describing it, though, it seems like you have to also own equities in this environment.
Yes. Yeah. And so that's a challenge, because if you look at the S&P 500, everything that's baked into the price probably takes into account next year's growth as well. So it's a difficult environment when you're looking at US equities, and particularly tech. You know, there's a lot of vulnerability there. But if you look into the more cyclical equity markets, and so there, Europe is a clear a clear good candidate there. I would say Japan as well, particularly with the weakness that Japanese equities have suffered in the last 3 weeks. That's a major upside trade, I think, for equity investors, is to rotate out of the US into Japan and into Europe. And still there's upside in that inflationary environment.
If there seems to be two scenarios here for the Fed. They either go early and deal with the inflation story, and that is one scenario for the shape of the curve. But if they're late and lift off aggressively, that's a completely different story as well. One's flat, one's steep. When are we going to know which one it's going to be? Well, the first choice, that would be a policy error, and it would be immediately cause a twist flattening of the curve, and risk assets would sell off. And I don't see how they can deliver on that scenario unless they're forced to. And by forced to, I mean unless we are faced by runaway inflation, where wages spiral higher. And today's data doesn't show that. Unemployment rate came down, wage growth didn't accelerate. So I don't think the wage spiral is imminent at all. But structurally higher inflation is something we've got to get used to. And there will be, as long as central banks don't rush, you know, the Fed, the ECB, then they will be able to lift off, but they have to be much later than they're currently talking of in their dot plots. Taper's got to be very slow. The exit has to be very managed and very slow, and therefore they've got to tolerate inflation going uncomfortably high.
Peter, quickly, if I was to say, well, I'm going to say to you, what is a safe haven asset right now? In the middle of this, it's confusing, and it's hard for economists and market participants to figure out what to do. Where's your safety net?
I would say if the central banks are able to avoid rushing to a tightening, if they can continue to deliver on their new mandates that they gave themselves, so I trust that they saw this situation coming, then I'd actually say that EM credit is a good example of something that can behave as a safe haven in this inflationary environment. And generally speaking, still there is upside to some inflation products as well.
Peter, thanks for coming to see us. Thanks for coming to see us in person. Peter Chatwell from Mizuho. This is Bloomberg. Let's take a look at where European markets, equity markets are trading as we head towards the close of this Friday. The payroll number, weirdly, despite it being a massive miss, has actually delivered very little in terms of volatility for global equities. You've seen it in the States, you've seen it over here in Europe. The FTSE 100 is tracking a little bit higher today, the DAX is tracking a little bit lower, the CAC Caron's down by around 0.5%. But kind of relative to where you would have thought we would have been, considering the scale of the miss that we've just seen coming out of the US payroll number, I'm surprised that we're not seeing more volatility and actually higher volumes. Volumes are quite low as we come into the end of the day, end of the week. Anyway, what are we going to talk about next? Only Russian gas can save Europe this cold winter. That's according to Woodmac. We're going to get the author of that research next. This is Bloomberg. Mixed picture here in Europe as we come through to the end of the day this Friday. It's been an incredibly choppy week. And in some ways, as I said before the break, you would have thought, given the miss that we've seen on payrolls today, that you would have got a bigger equity market reaction. It's not happening. European stocks are basically just going sideways today. You got the CAC down a little bit, only down by 0.5%. Now, in kind of normal times, that wouldn't be a very big move, but actually, in these times, it maybe is a little bit bigger. But nevertheless, the DAX is only down by 0.2%. London's up by 0.3%. Europe, basically, in aggregate, is going sideways. But it has been an incredibly choppy week. So let's take a look at what the week has looked like. This is the Stock 600 over the last 5 days. And basically, it looks like a seesaw. It is up, down, up, down, up, down. We used to call it RORO, risk on, risk off. That seems to have been the story. There's been a lot going on. We had a lot of economic data. The gas story has been really front and center here this week. So there's been a lot to factor in. But at the end of the week, equity markets are still up by over 1%. Which is worth kind of just thinking about in terms of all the challenges, all the things that have been thrown at this equity market this week. very few of them have stuck. We're not up in the mid sort of 70s, 470 we were. Now we're sort of in the high 50s, 457. But nevertheless, it's been an incredibly choppy week. So let's take a step back and take a look at kind of what's been going on from a sector point of view. I think that's probably worth dwelling on as well, just to give you an idea of the kind of rotation that we have seen. The GRR gives us that as well. There's been some individual stock stories that are worth focusing on as well. But the GRR kind of gives you just an idea of what's happened here. The rate market and the bank story have gone hand in hand. So what we have seen this week is yields coming higher. That has helped the banks out. So banks are looking as the winner this week. But then you look at the basic resources, the inflation narrative. Basic resources, the miners there, the energy's there as well. Both of those two sectors have picked up really quite strongly. Bottom end of the market, travel and leisure. There has been some equity issuance this week, but more broadly, a lot of confusion about what the state of play is in terms of travel rules, and higher energy costs are going to feed into that sector as well in a negative way. Retail has not had a good week. Real estate's not had a good week as well. So it's really interesting to see how the narrative has developed. But I would say banks, basic resources and energy is the real takeaway story this week. The other narrative, as I say, has been the inflation story around what's been happening with commodities. And here you've got the kind of the one, that should be the 1 week nat gas story, but it's not. That's the 1 week stock 600, which we've just taken a look at. But nevertheless, gas this week, again, kind of shooting to the moon. I think it was Wednesday. We got that kind of really big move first thing when I got into the office, kind of plus 40%. Then this kind of big move down as Vladimir Putin came in. There you go. You can see it there. This kind of move up and then down. On the week, gas prices are down by 10%. At one point, it looked like it was going to be a very different narrative. And we'll get the view from Wood Mackenzie in just a moment. I want to wrap things up by taking a look at some of the individual stock stories, the single names. I've gone for the kind of the MRR 1 week here, i.e. it pulls together all of the gainers that are on the week. And what I can tell you, because I'm not going to be able to show you this, is that Tesco is one of the real standout stories. The UK supermarket sector is still absolutely front and centre, Alex. There's a lot of people circling the UK in terms of picking up assets. Private equity very much looking at this story. Going into last weekend, it was what was going to happen with WM Morrison. I think coming out of this week, it's what's going to happen to the UK consumer. Is the cost of living sort of story going to be one that actually ends up being a huge issue this winter as we do see these gas prices coming through? If you've got to pay your gas bill, you're not going to be able to buy other things. And I think that's something the UK is going to have to deal with.
Yeah, absolutely. And already you're seeing shortages on shelves of items, and then you add on this. So let's dig down into that gas story. You had a plant in Russia explode. There's an explosion and a fire there. They say it's fine, and they can still get all their gas to China. But if they can't, and it's a key pipeline that goes to China, if they can't, China's going to have to go back on the spot market and buy more natural gas. That's going to distort the market even more. Let's break it all down with Wood Mackenzie. They say the region in Europe is going to be wholly dependent on Russian flows. Joining us now is the man behind the call, Massimo Dioeduardo, Wood Mackenzie Vice President of Gas and LNG Research. Massimo, okay, Europe is dependent on Russia. Does Russia have the supply to refill the tanks that we need and supply Europe and meet their full demand?
Well, they certainly have the gas. The point is just how much pipeline capacity they will have to supply gas to Europe. And so at the moment, they'll be using existing capacity, probably not up to just how much people would want them to supply. But what we think is that if they use all of that capacity, and they certainly have the gas for it, and the winter is relatively normal in Europe, we don't think Europe will have an issue in meeting demand. The question is whether the winter is going to be cold. That's certainly a different outlook.
What's the best case and worst case scenario here for Europe?
Well, again, so the best case, which it's normal weather condition across Europe, but also across Asia. And again, we think that under that condition, actually the market should end up the winter in a situation where storage are going to be lower than normal winter, but still in a relatively comfortable position. We estimate that could be in the range of 28 BCM, so quite high. But if you get a cold winter in Europe, that could add 20 BCM of demand. And if you get a cold winter in Asia, that could reduce LNG imports to Europe another 10 BCM. And so you've got 30 BCM in storage and an additional 20 BCM of demand for the winter in Europe and 10 BCM less LNG imports. You can do the math yourself. You end up with zero gas into storage. That's the worst scenario. And that's when only additional Russian gas can actually save the market.
Okay, so that's the worst case scenario, but I'm wondering if we're setting ourselves up for a one-way trade at this point in terms of volatility and higher prices. Like what happens if the winter is actually warmer, or we're still at 76% of storage capacity in Europe? That's not zero. Where's the risk? Where's the upside risk?
Well, the upside risk, I mean, to your point, if the winter is warmer than average, then actually demand could be some 10, 15 BCM lower than a normal weather condition. And so, and so in that case, we could actually end up in a situation where storage could be comfortably at the 35 BCM normal weather condition. So it's a very volatile situation. But I think what the market is really concerned on is the cold winter. And again, not knowing where the gas is going to come from if that happens.
In terms of individual countries, who's the most exposed here? The UK looks like it's kind of front and center right now. How different will each individual country be in Europe if we are going to see the worst case scenario? Is it going to be everybody's in the same boat, or are different countries going to fare differently?
I think in the spectrum of country, to your point, you've got the UK, which is going to be in a very perilous position, and that's because its storage capacity is extremely low compared to demand. There could be as much as only 10 days of storage demand left, in the winter, and so it would only be fully be dependent on gas coming from Northwest Europe. And you can imagine that if the situation gets really bad, then whether that gas is going to flow to the UK might be questionable. On the other side, you've got Italy, where there is a requirement to put gas into storage, regardless of pricing dynamics. And so, to some extent, Italy is in a better position than other less regulated markets because, again, it's been able to fill up storage up to points. I mean, obviously, the market is all very well interconnected, but certainly on one extreme, you've got the UK, and on the other extreme, you've got Italy.
Walk me forward to next year, for example. What's the long-term effect of this going to be? Vladimir Putin was blaming the fact that Europe had been opting for more of spot market buys for LNG versus longer-term contracts. Obviously, Putin's going to be talking his book with Gazprom, but that's not an irrelevant point. We had been transitioning the market. Those 15, 20-year contracts were harder and harder to come by. Does that change now?
I think it's hard to think that we'll go back to to a lot of long-term contracts. I mean, there will be changes in contracting dynamics, right? So you will see buyers making sure that they've got access to LNG imports. But I think what can really save the market in a situation like this is effectively having more gas into storage. Is effectively something that the European Commission is trying to get warmer to, of the fact that one option to save the day, obviously not this winter, but as it builds up, is effectively try to develop additional storage, possibly regulated storage, and develop strategic reserves, so that when we get back to situations like this, that could be the supplier of last resort, and certainly that could be a way to manage a situation like this, which again, if there is a cold winter, could really spiral to something unprecedented.
If we do get the worst case scenario, if we get close to the worst case scenario, how does demand destruction work? Presumably that's what we would have to see. How does the process of demand destruction work if there is not enough gas and gas prices are too high?
Well, if there is not enough gas, eventually, some of the gas that has been sold through interruptible contracts, and those are contracts that specifically consider the possibility of interrupting that supply, eventually some of those contracts will have to be triggered. Those are never really triggered because those are part of the agreement between buyers and sellers. But again, I think it's much more likely that some of those interruptible contracts will be triggered instead of Europe going down to zero storage. We'll certainly see that ahead of Europe going down to zero storage.
And that would likely slow economic growth down. Massimo, we're going to leave it there. Thank you very much indeed. Massimo D'Edoardo, Wood Mackenzie. Thank you very much indeed. Quick look at where European stocks have settled. As I say, not the kind of reaction you would have expected given the miss that we saw on payrolls. We have basically gone sideways in Europe today, Alex. The FTSE 100 getting the best of it, up by 0.2%. The DAX is down a touch. The CAC just dipping a little bit into the close, down by 0.6%. All
right, well, here in the U.S., you're taking a look at a steeper yield curve, and financials the second best performer within the S&P. Also, by the way, bank earnings come out next week. We're going to dive into what to expect from them, what's already priced in with Betsy Graysick, Morgan Stanley, Global Head of Banks and Diversified Financial Research coming up next. This is Bloomberg.
This is Bloomberg Markets, the European close. I'm Ritika Gupta, and you're looking at live pictures of the principal room. Coming up, Tracy McMillan, Wells Fargo Investment Institute Global Head of Asset Allocation Strategy. This is Bloomberg. Let's check in on the Bloomberg First Word News. I'm Ritika Gupta. For the second month in a row, the U.S. economy added fewer jobs than forecast. Payrolls rose by 194,000 in September. That's the smallest advance this year. The unemployment rate fell to 4.8%, partly reflecting a decline in the size of the labor force. All this could complicate a potential decision by the Fed to start scaling back monetary support before the end of the year. A key hurdle has been removed on the path to an unprecedented deal that would reshape the tax landscape. For multinationals, Ireland will abandon its 12.5% tax and push for a floor of 15% on corporate profits. The OECD is hosting a crucial meeting on taxes for 140 countries. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Alex.
All right, thanks so much, Ritika. So big banks report earnings next week. You got JP Morgan on Wednesday, Bank of America, Morgan Stanley, Citi, Wells Fargo all on Thursday. That's going to be a busy day. And Goldman Sachs on Friday. I want to get a preview with that with Betsy Graysick, Morgan Stanley Global Head of Banks and Diversified Finance Research. Betsy, the simple question is, what's this quarter about?
I think this quarter is about two things. One, showing that buybacks are accelerating, and two, showing that NII does have a forward path, does have an opportunity to go up as we look forward.
Betsy, is that this quarter or next quarter?
Some stocks you'll begin to see it this quarter, in particular in the consumer finance names that I cover, in particular on the card space. And of the big banks next week, we will begin to see that in their card portfolios. For overall, I think we're looking at, really a 2022 story here. But it feeds into some of the stuff that you've been discussing this morning, interest rates rising and loan growth is accelerating. A lot of people push back on that, but it's happening.
Where is loan growth accelerating?
Number one is in card. We do have credit card in the U.S. right now running at about 2.5% up on a year-on-year basis. Look, a quarter ago, that was shrinking. That is new news. There's a lot of debate as to how much of this is true revolvers versus transactors just spending more. But that'll be an interesting discussion that comes out next week. The C&I book, a lot of people are looking at, when are we going to get the commercial and industrial loan book to start growing again? And we've spent some time digging into this. It is already growing in services, in financials, in government. Where it has been shrinking is in the supply chain, utilities, energy. So when will that supply chain flip? We think we're beginning to see the signs of that, but just very nascently right now today. As PPP rolls off and we go into 2022, we think you'll see a sharp pickup in C&I lending.
Where am I going to get the biggest bang for my buck on buybacks? Which bank is going to deliver that?
So it's really in the card space where you've had a high level of capital coming into the pandemic and even higher now coming out, as well as reserve release still has a lot of reserve release to come through. So which name is that specifically? Synchrony Financial. Now, I know they don't report next week, but it's in the week following. We think that's going to be number one. The other big stock is going to be Wells Fargo. And Wells Fargo has a significant amount of excess capital. And as you know, they've got the asset cap. So they will be, also in the running there for biggest uptick Q on Q.
Betsy, back to the loan growth for just a second. What's the best way to play this inflection point that we're seeing consumer credit growth, sort of those loans now, and then you'll start to see the supply chain and industrial loans in early 2022? How do you play that?
So the way we're positioned right now today is we are overweight in our portfolio a little more towards the card names. Synchrony Financial, Capital One, American Express. As we move into next year, we do expect to see some pick back up in the C&I-oriented stocks. Where I'm overweight today, with that kind of trade in mind, is Regions Financial. They have a bit of a skew to C&I, and importantly, they're not involved in a big deal, right? They've done some small acquisitions. Why do I care about that? They're boosting their C&I loan growth through these acquisitions. And I think they'll be sooner back to the table on buybacks than competitors that have been doing big deals, big depository deals, I should say.
Betsy, the market still feels top down rather than bottom up, particularly when it comes to the inflation story. The macro is driving a lot of things at the moment. How good a hedge are the stocks that you cover if we are going into a higher inflationary environment?
A very good hedge, I would argue. Look, the bank stocks should do very well in a rising interest rate environment. And importantly, I know the market's going to be beginning to discuss this question of what is good inflation versus bad inflation. Good inflation is when you can pass that higher input cost on to the buyer of your product. It's when your wages are going up faster than your daily necessity basket, cost of goods, for example. Our view right now today is that we're in a good inflation scenario, and that's a positive. It's a scenario that should bring rate hikes sooner rather than later. And it's a scenario where the borrowers are able to service their debt and potentially even take on more. So we're very positive on the banks for a variety of reasons, one of which we think loan growth is going to pick up, another one that the curve steepens. Those two things out of the four drivers of earnings, those two things really haven't yet come through. We do expect that will be happening as we go through into 2022.
Hey, Betsy, broader macro question here. If you just take a look at the KBW Bank Index versus the S&P versus the 10-year yield, I mean, you've definitely seen the KBW outperform, not yet totally keeping pace with the 10-year. There may be a little bit more juice in there. If we just take into account the big guys going into next week, have they kind of topped out here? Have they maxed out on this sort of inflation/reflation steeper yield curve play?
That's not my opinion. We still have, some upside for the big stocks. We cover the megas, call it the B of A, Citi, JPs of the world. Out of those three, we're overweight Citi. We are currently underweight B of A and JP. It's really a function of their valuation being a bit more full than the rest of the group I cover. But there still is upside for the names. Now, importantly, what do we have in our outlook here? We've got 2 rate hikes in 23. And with all the talk of inflation, obviously the question on the table is, could that be more sooner? That would drive up my estimates, bring down the multiple, make it more attractive to own the stocks here, obviously. I think it's going to be really interesting to see what Jamie Dimon says on Wednesday, right? Because at our conference in June, he did a bit of a mic drop. He did a mark to market on the NII for the full year, given where rates were and the curve was. He hasn't really spoken publicly since then, and well, at least in a large forum on this topic. And I wonder, is he going to say that given this rate outlook, that we'll end up having a bit of an uptick in net interest income as we look forward here?
Been pretty down on the bond market for quite a while. Betsy, it's going to be a busy week. Thank you very much indeed for setting us up for it. Betsy Graseck, Morgan Stanley, thank you very much. This is Bloomberg.
All right, we got energy moving higher here, but heavy trading in the U.S. Coming up, there's still a lot to get through here. We got the IMF on Monday and World Bank annual meetings. They're going to begin, so definitely watch that. What the leadership's going to look like at the IMF, I feel like, is definitely in question now. Plus Tuesday, the IMF economic outlook, and my personal favorite, William Shatner is going to go into space with Blue Origin. I feel like, to me, that's going to be the biggest deal next week.
There's going to be a lot of Star Trek jokes next week, aren't there?
So many. I have to brush up. Also,
no, I think I'm going to spend my weekend kind of thinking of all the decent quotes and the decent jokes.
Yeah. I think that's a good call.
We've got haven't we got minutes from the FOMC next week? That should be interesting in terms of the insight that we're going to get. It's a bit rear view mirror, but nevertheless, post payroll. As we've just been hearing from Betsy Gracek, JP Morgan, obviously that's going to be a firm focus. The bank story really going to be interesting next week, I think. We've got earnings from Bank of America as well. We've got Morgan Stanley, we've got Citi, we've got Wells. It's going to be a big banks week. Friday, Goldman Sachs, plus retail sales. We'll find out what Alex has been up to, basically.
I'm buying stuff. I'm definitely buying stuff again. But now I'm thinking Christmas. Buy stuff now, stockpile for Christmas.
Yeah.
Anyway, so that wraps it up for me and Guy this week on Bloomberg Television. Coming up, Constance Hunter, KPMG chief economist, joins Balance of Power with David Weston on Bloomberg Television and radio. Guy and I are headed to radio, DAB Digital Radio, the cable. Check it out. This is Bloomberg.